Bank of America experts say that a famous recession indicator in the bond market has been flashing signs of an upcoming downturn for months. According to history, this is a sign that a downturn could start this quarter. Strategists pointed to the flattened Treasury yield curves, especially the spread between the 2-year and 10-year yields, and the spread between the 3-month and 10-year yields. When short-term yields are higher than long-term yields, it's often a sign that a recession is coming. For example, the inverted 2-10 spread correctly predicted the recessions of 1990, 2001, and 2008. The experts say that in the past, a recession starts 6 months after the 2-10-year curve goes down. Since the prices on these bonds went negative in November of last year, the recession should start in May. Recently, the 2-10-year yield curve had its greatest reversal in more than 40 years. Analysts at Bank of America said that the market can see the fall of Silicon Valley Bank as a big sign for the U.S. economy. This is why the inversion got worse in March. DataTrek said in a note that the difference between the yields on 2-year and 10-year Treasury notes is the biggest it has been in about 40 years. This is a well-known sign of an impending recession and could mean that stocks are in for more trouble in the future. Since almost a year ago, the yield on a 2-year note has been higher than the yield on a 10-year note. This inversion has only gotten worse in the past few months. On Monday, the 2-year had a yield of 4.241%, while the 10-year had a yield of 3.578%. It's the deepest inversion since the early 1980s, and it could be a bad sign for the economy because an inverted yield curve has been a very consistent sign of an upcoming recession. Since the Federal Reserve took strong action last year to stop inflation by raising interest rates by 425 basis points in 2022, worries of a recession have grown. Prices have gone down a little since they were at their highest last summer, but some people worry that raising rates above where they are now could make the economy too tight and send it into a slump. The inverted 2-10 spread doesn't mean that a recession is sure to happen, but Colas warned that the economy is now more likely to be hurt by something outside of it. Stocks should also get ready for more pain. It's hard to argue for a strong stock market or valuations when the 2-year yield is so much higher than the 10-year yield, because we know that this difference shows that the U.S. economy is inherently weak, he said. The yield curve says the recession is starting now, experts wrote in an email on Friday. The markets are waiting for confirmation from the labor market. Inverted yield curves signal recession, but once recession begins, the yield curve immediately steepens as market discounts Fed policy response to recession, they added in the note. The gap between the 3-month and 10-year bond yields has barely widened, but the bank said that if the inversion between these yields gets worse in the coming weeks, it would be a strong sign that a recession is starting in the second quarter. Over the past year, strategists have been warning of a slowdown as central bankers have raised interest rates by more than 1,700% to bring down high inflation. Experts say that rates that high could easily send the economy into a recession, especially since Fed officials have made it clear that rates are likely to stay high for a long time. High rates will likely keep hurting jobs and company earnings, which is bad news for stocks. Even though stocks are pricing in just a 4% drop in corporate profit, the bank said there is a chance that companies could face bigger headwinds because of rising interest rates and a possible recession.
Thanks for watching. Don't forget to click the like button. Subscribe and click the notification button if you want more daily updates on building wealth, personal finance, and achieving financial independence. And remember, the world is yours.